Good evening, traders. Welcome to Trading Tuesday on the Phoenix Blue YouTube channel. Tonight we're going to have a look at central bank intervention that's having a big effect in the markets at the moment. We're also going to look at the crude oil production in inverted commas deal that's been in the news over the last few days. Before we go over to that, just a reminder that we are on Instagram at Phoenix Blue Trading, where we will have regular updates through the day on trading positions, etc., etc. Any questions, any comments, anything you'd like to know, please email us at info@phoenixblue.co.uk. We're on Facebook, Phoenix Blue Trading, and very shortly we will be launching the Phoenix Blue website. Okay, so let's make a start on central bank intervention. Okay, what we're going to talk about here is two specific cases which have had major significance in the last few weeks. The chart at the top is for the USD CNY, being the Chinese yuan pair. The chart below, USD JPY. Over recent months, we've seen the Bank of China weakening the yuan relative to the dollar. They've been doing this on purpose. They actually fixed this rate. It's not a free moving market. This period here was the Chinese New Year bank holiday last week. Return from that on Monday saw a massive opening gap down. Basically what the Chinese have done, how they've decided to significantly strengthen the yuan against the dollar. This line here is the end of last year, 2015 level there. So having devalued since Christmas or since the new year, they've now pushed price back down to that same level there. Now, the reason they've done this is over the last couple of weeks, we've seen a lot of turmoil in the marketplace. We've seen big sell-offs in equities worldwide, and the blame for this has been put at the door of a fear of worldwide deflation, and the cause of that being this devaluation of the yuan. The Central Bank of China have stepped in and made this big statement, this big move here, which came out of the blue, although the head of the bank had said the day prior that the central bank weren't willing to see speculators control the markets. So to one extent that was a hint, and this was their answer to that. Okay, what we've seen in the yen is at this point here, the Bank of Japan surprisingly announced a move to negative interest rates. The Japanese economy has been virtually stagnant for the last 20 years, virtually non-existent inflation, and they continually, their policy is to devalue the yen in order to stimulate inflation in their economy. Now, the result of that was over the following few days, it had the desired effect. The yen weakened, but then the rumours that we've spoken about earlier started hitting the marketplace, or the worries about worldwide deflation and a run from risk assets to safe havens, the Japanese yen being one of the most significant of those, and particularly being the one or the currency for the Asian markets, or the Asian part of the world, where funds will run to in times of concern. That drove the yen price really back up to this point here. At this point here, we highlighted that we were expecting to see intervention from the Bank of Japan, on the basis that we said they wouldn't allow price to fall indefinitely. This seems to be the line in the sand, and through the back end of last week we saw a reversal from there. Interestingly, what happened with the move on the Chinese yuan was we got follow through on Monday, driven by this increase or strengthening in the Chinese yuan. Through this period here, money had been getting out of yuan-based assets and moving over those funds over to the Japanese yen safe haven. So basically we can effectively see a mirror effect between those two, and basically what we're seeing is this is what's causing the fluctuation between risk off, risk on and risk off again over the last couple of weeks, which has made so many dramatic moves in the marketplace. Okay, so moving on from there, the next thing I wanted to talk about was crude oil production and the deal that hit the news this morning, that there was an agreement between Saudi Arabia, Russia, Qatar and Venezuela to restrict crude oil production to January levels. What the chart is American crude West Texas Intermediate, and this is a 60-minute chart. The market's initial response to the news was to take that as a positive news for crude oil. However, once the information was properly digested, traders began to understand that this was an agreement to not increase production. It was an agreement between four parties, and was subject to other crude oil producing countries coming to agree the same agreement. Now, traders were thought this is pretty unlikely. The likes of Iran are currently ramping up production, so we immediately then saw a very strong sell-off. And this is a classic example of the market reacting to news, initially positively, but when having actually understood exactly what was happening and what the true effect was, we've actually had a bigger move in the opposite direction, and more instability in the price of crude, which is another reason the markets have been so dramatic over the last couple of weeks. Okay, now let's turn over to trades we're currently in. We mentioned when we were looking at the yen chart there that we had highlighted our expectation that the Bank of Japan would step in to support or to devalue the Japanese yen when it had reached a certain point. We highlighted, apart from the yen itself, these four JPY crosses: CAD JPY, Aussie JPY, Euro JPY and GBP JPY, all of which were at significant resistance or support at the same time. The CAD JPY trade, sorry, that's a bit small, but this second low here is the trade we took. The traders' long stops have gone to break even. We've taken money off the table. We've had a bit of a stall today due to the oil price, but we're still in that trade. Aussie JPY, we took this low here. Price went with us. Price was bullish. We got our stops at break even. We got money off the table before price came back and stopped us out at break even. So that was a profitable trade, even though we didn't get to our second target. Exactly the same happened on Euro JPY. We had the entry there. Price went in our direction. We took money off the table, stops at break even, and price came back to stop us out at break even. Another profitable trade. The pound JPY pair, other than being inverse to look at, price reached the support level. The Bank of Japan intervention did exactly what we expected. We've taken T1 profits. Stops are at break even, and this trade, like the CAD JPY trade, is still up and running and looking for T2 targets. Okay, the other trade that we're currently in at the moment is the sugar trade. We got in this, I believe it was mid to late November, on a COT extreme signal right up here. It took a long time to actually move. Then the other week we had a dramatic drop just after we'd taken, to be fair, 50% off the table because we'd waited so long for the move. Price has now come back into our add-in zone here. The entry's gone. We have T1 targets, profits taken, stops at break even there, and we have a target at this low here. But interestingly, with this one at the moment, it's pulled back today, back up to this zone. We're still in the trade. We still have our short bias on it, but we'll need to wait and see what happens. We'll be confident of hitting target once this low's taken out in the next week or maybe 10 days. Okay, over to trades that we're actually have resting orders on. We're looking at entering. We had an order in yesterday for gold at a level a little bit higher up here off a trend line stroke channel. Unfortunately, the volatility in the market caught us out there. Price went in our favour, but overnight came back and hit our stop before heading back where it had started. So that trade was a loser, but we tell you about our losers as well as the winners. We now have another entry in at this level here. This is a really lovely level. We've got touches right through here, 2010, 2009, 2013, most recent touch in the last quarter of last year. And if you look at the daily chart, or you were watching the morning update this morning, we had a lovely little daily retest of this level. However, today, because of the events with the oil agreement on the production deal, we saw the gold price not quite come down to entry. Our entry moved off. This is still a very, very valid entry, so we'll be waiting for price to come back to that entry patiently from that point on. Okay, onward from that, we have another order in the market. This is a resting order on cocoa. We're looking at the daily chart here. We have an entry on what was last week's weekly bar. With a relatively big risk to stop. Our target is up here. We're looking at a return of about 3 to 1, but we are at this moment mired in this congestion here, waiting for the breakout to happen. Now, what I want to show you relatively to this now is the Commitment of Traders report for cocoa. This is from Tuesday last week that came out at the weekend. We've got the chart of cocoa here. This is the 6-week COT index. And as we can see, we've got an extreme signal here indicating that a bottom is imminent. We've hit a bottom. We're at that point now. We're waiting for that breakout of the congestion zone that we saw a second ago. However, what we've got down here, these are the commercial long positions. And if we look at these and we go back historically, the last time we were down at this sort of level, at a low through this point here, or more specifically here, the commercials had a considerably higher long position through here, tying in with that there for the big strong bullish move through there. Okay, what we've got at the moment is congestion, and I believe that this is the commercials purposely creating that in order for them to allow them to build a bigger long position before releasing the market away with a big bullish move. So it's congestion, and they're creating that to take the opportunity to build their position so they can profit from that, from selling their longs as the speculators buy longs on the way through the long bullish move up here. Okay, I hope that made sense. Okay, right, now just have a look at some charts, just give you some updates. this week is relatively quiet at the moment. Yesterday was the American bank holiday, so we had low liquidity. Not a lot's changed since the watch list went out at the weekend. But here we have the New Zealand dollar, and we have in the watch list we talked about a potential entry at this level through here for this zone. What we seem to have picked up since that was actually shown is we appear to have a rising wedge. From a rising wedge we would expect a breakout short. So we're going to be keeping an eye on that to see how that works in and around this zone here, and may wait for it to break short rather than simply taking it as soon as it hits that zone, because it could come back down to this area, back up there before breaking out of that. So that's really just an update on something that's developed on that chart. US dollar CAD, we have talked about this level here. I noticed in the watch list that we were showing the fibs drawn from this point here on this trend line. None of them actually coincided, but the fib from this point here at the bottom of the trend line perfectly touches this low here to the pip. We've got another touches around there, so that reinforces our view on this. In an ideal world, we would look for price to come down and actually touch that level in and around the confluence with the trend line to give us even more probability before continuing long with our bias. We still see the crude position being potentially, or the price of crude dropping to even lower levels than it is now. The fact that the deal we've already spoken about fell through, or the market saw it as having fallen through, possibly reinforces that. So again, that's just an update on something that was on your watch list. Couple of other things, again, more longer term. The S&P 500, we've been watching this. We've been watching for a potential break below these levels in order for the market to collapse down to levels probably around 1500, something like that. Interestingly, what we found picked up in the last few days is we've got a weekly channel running through here, which would explain why this low came in lower than that. So again, that's something that we can possibly take into account as this market moves forward, and look to a break of the channel rather than just a break of the horizontal and the channel, rather than just a break of the horizontal itself, before we get a close below, looking for a pullback and re-entry. Similarly, or slightly different, on the Dow Jones Index, rather than having a channel this time, we've got a triangle. Here, this was a rising wedge that had a breakout back in December 2012, it looks like. In fact, I think that gap's probably the Christmas period, but we had a break above, a clear pullback on this weekly candle here, off we went to the new highs. Again, unlike the S&P, we had a low here, but this time not as low as the preceding two lows, but we now have a clear trend line there, and also the downward trend line, so we'll be looking for a breakout of this triangle, a close below, and similarly pull back, retest to take our trades short. Okay, that concludes everything for this evening. If you have any questions, please do contact us at Phoenix Blue, info@phoenixblue.co.uk. Now, the markets are very volatile at the moment. You need to be cautious. We've talked about bank intervention and the effects that's been having. If you do trade with caution. Potentially reduce the risk on your trades, and be very aware of how many, or the total value you have at risk in the marketplace, and also with resting orders. Okay, thank you for listening, and we'll wish you good night. Goodbye.